All right, so now it's November 22nd, been almost 2 weeks since the amazing day, November 10th. There's the video up above as to why rates went down. It's because inflation came in much lower than expected. So watch that video up above. But what I want to chat about here was 12 days later, we have seen that not only you see this big green bar here, hopefully you can see that big green bar in the middle of the screen. That was the day that rates improved a ton. Remember, up is good for mortgage bonds. You can see we had a little bit of a roller coaster ride to be expected, but today's another great day. US Treasuries are down. So this is all indication that it wasn't a fluke as to what's going on in inflation. Now, I'm going to add a new flavor to it, which is you're going to hear this, that the economy is very resilient, and it is. People are still spending, right? And so does that mean we're still going to have problems with inflation? But let's peel back the onion a little bit as to why people are spending. So let's take a look here. So guess what? Credit cards, right? If you take a look at this chart here, you can see spending on credit cards. The pandemic hit, and part of the reason for why we got inflation is because people stopped spending. Maybe they had less to spend it on, right? They weren't going to Starbucks, they weren't going out as much, they weren't traveling. So we saw the amount of spending on credit cards drop dramatically, and now we have hockey sticked, right? And it gives you an idea of what people are doing now. So part of the resilience in the economy that we're seeing right now is that people are spending on credit cards. And that is a piper that needs to be paid, because guess what? Rates on credit cards are higher now because of what has been happening. So does this mean there's gloom and doom? No, it just means that eventually those people are going to need to stop spending. And just like normal, some of these people file bankruptcy, some of these people go late, but the majority of it just end up curbing it back and having to spend less because they got to pay on their credit card debt, right? End of story. If you take a look here, it shows that people are also digging into savings. So again, if you look at the US personal savings rate, the stimulus checks came out, right? And people got used to that. So yes, some of that stimulus was not used for what it should have been used for. It was saved. Now, for some people, they were saving it for a rainy day. That's not necessarily a bad thing. But people did get used to an additional income, right? And so now we can see that savings rates are way down. So what is this talking about? So yes, the economy has been resilient to this point, and we want that to be the case. We want people to, spend money on consumer goods and cars and all that stuff. That is what keeps the economy going. But clearly, if you see what's going on here, it's got to slow down, right? People can't dig into savings permanently. They can't go on credit cards permanently. It just ends at a certain point. So this amazing consumer spending report that came out, a little bit of an illusion as to what's going on here. So what does this all mean? What it means is that whether we're in one now or not, the economy is going to slow down, and everything is aligning up for rates to continue to drop, right? And so people right now are buying houses. They're getting in under appraised value. They're getting the seller to pay closing costs, right? They're not waiting. They're getting it in now, and then we are automatically refinancing everybody at huge discounts in the middle of next year as they go down, right? So that is what is going on. Anyway, one word here, remember this, not all loan officers are created equal. If you have any questions, give me a call. Happy Thanksgiving.